Alright, hi everybody. Today we are going to record a question and answers video. Over the last couple of weeks I received a ton of questions. So we're going to talk about a wide range of different topics, including my take on the book Rich Dad, Poor Dad, my take on small cap stocks, my biggest financial milestone, my past and what has led me to investing, my watch list, factor-based investing, and last but not least, also my favorite type of food. So it's also getting a bit more personal in this video. And what I should say is that I haven't really prepared for this video, and I'm just going to work my way through I think in total it's 14 questions. And so without further ado, let's jump right into it. Alright, so the YouTube user or YouTube account Ominolo asked a bunch of different questions. I'll focus on two of his questions in this video. I'll start with the first one. What has actually led me to investing? And I actually get asked this quite frequently. And to be honest, please share your experience in the comments down below. I'm not really sure. Like, what I do remember is that I was at a party around 7 to 8 years ago. And I remember that people were talking about ETFs. And I had no clue what an ETF is and what it stands for. And I think sometime in the subsequent weeks, I started getting interested in the topic. I'd also quite recently started working my first real job. And for the first time, I had some significant sums of money left over that I had no clue what to do with. And I had no clue how to make use of that capital intelligently. So I started learning about investing and luckily, I guess I came across the discipline of value investing relatively quickly. I still remember that one of the first books on the subject that I read was Good Stocks Cheap by the author. I think he's called Kevin Marshall. And I think to this day that this is a really good book that is maybe already a bit advanced. So I actually read it like 2 or 3 times to fully comprehend the most important concepts. And yeah, I guess ever since I never looked back. Over the last 7, 8 years now, I probably learned something new regarding investing every single day, and I still enjoy the process. All right, question number 2, this time from the YouTube account Peter. He asks, your confidence level in percent that the S&P 500 will have a 10% or more price increase in 2024. So those who are regular viewers, they will know that my answer will be that I don't know. You cannot know what the market will do over relatively short periods of time. But I think the user, so Peter in this case, acknowledges this already by asking just for a percentage number. And I guess what this question reminds me of is a video of Joseph Carlson. You might know him. He's another creator in the YouTube finance space. And he was sharing this chart here. I guess I'm just going to show it on screen right now. That shows the annual returns of the S&P 500 over a long period of time. And he was actually pointing out that very rarely the S&P delivered the long-term average return of 10%. I think he kind of did the math and figured out that only 1 in 5 years will actually generate returns between 0 and 10%. However, what this chart also shows is that there are more years with a positive return than years with a negative return. So I'm kind of leaning, if I had to make a forecast for the S&P, leaning toward a positive return. So I guess the odds of the S&P returning more than 10% in 2024 aren't too bad. So I don't know, if I had to give a number, 60%. Question number 3. Do you have a day job outside of YouTube and the mentorship program? And if you do, then what is it? And how do you combine investing with the job and other things in your life, time-wise and energy-wise? Okay, interesting question. Again, those who watch my videos fairly regularly, they will know that I work as a teacher at a secondary school here in Germany, teaching English and it's kind of politics and economics combined in one subject. And regarding the question how I combine this with my investing activities, I guess first and foremost, I think having a regular job gives you an advantage as an investor. If I would imagine I would invest full-time and do nothing else, like you're kind of forcing yourself to think about investing all the time. But I think the fact that you have different things to consider, that your mind is not focused on investing 24 hours a day, 7 days a week, I think this gives you an advantage because in the stock market, doing less is often more. And I think Monish Prai actually addressed this in one of his talks. So he's doing a lot of philanthropic work. He's playing, bridge. Like he's doing a lot of things outside of investing. And I think he's doing this quite consciously to make sure he's not thinking about investing what he could buy and sell all the time, because he too acknowledges that, yeah, just sitting still, letting the companies do the work for you is oftentimes the smartest thing you can do. But besides that, obviously, everything I'm doing, like my YouTube channel, now the mentorship program, researching stocks on the side, all of this requires quite a lot of time and energy. But what I should say is I think I'm a pretty high energy person. You can probably not tell by my videos, but like I have a very hard time just laying around and doing nothing. So it's just the right mix for me, I would say. All right, question number 4. What is your take on the book Rich Dad, Poor Dad? And give me a second, because I know I actually have this book on my shelf. So I guess I'll just grab it. All right, there it is. I think we actually have 2 copies of this version. I think I once gifted my girlfriend a version of it, but she never read it. I have read it in the past, but quite a long time ago. Yeah, what's my take on it? I would say generally it's a very good book for anyone who is getting interested in the process of wealth building and maybe to some extent investing too. However, I think as a value investor, my perspective on the book may differ from the conventional perspective on the on how valuable this book is. So what I would say is, while the book is widely popular and has motivated many individuals to take control of their finances, I think it's also important to note that Kiyosaki's teachings are more focused on topics like entrepreneurship, real estate, and building businesses, rather than traditional value investing, what I talk about on my channel all the time. But I can definitely support the mindset shift that Kiyosaki is advocating towards financial education, building wealth, investing in assets, kind of the idea of developing passive income sources. I think that's a very valuable perspective that can be quite beneficial for anyone who's looking into money topics, wealth building topics, but it may not directly align with the principles of traditional value investing. And Kiyosaki himself, I don't know, I think he's known for kind of having become a crash guru. You might have seen this chart here. I'm just going to show it on screen right now. Where he is kind of predicting all sorts of stock market crashes that for the most part have never materialized. So just to wrap it up, I think it's quite a valuable starter book for anyone who's interested in wealth building and to some extent investing. But I think if you want to take the next step, learn more about Warren Buffett style of investing, you will have to look elsewhere. Okay, question number 5 already. This time the question is, what stocks do you have on your watch list? I have a ton of stocks on my watch list and I can't share everything here with you. But I remember that I was responding to a tweet quite recently. And I think the initial tweet was about the issue of finding too many attractive stocks to invest in. And I think my response was that finding very good, like world-class, excellent businesses, that's probably not the hardest part of investing. I think that's actually relatively easy. The harder part is to wait for these businesses to trade at a price that will also give you very satisfying market-beating returns. So I think this is actually a problem that I encounter all the time. People and retail investors in particular are just not demanding enough. They are not waiting for the really fat pitches because they are not patient enough. And I have to admit, just sitting there for an entire year, making no new investments, that is much, much harder than most people can imagine. So I can definitely resonate to why that is a difficulty for many people. But nonetheless, I think finding good businesses at spectacularly good prices, this is indeed very hard. But just finding good businesses, that's actually fairly easy. So a couple of businesses on my watch list, for example, are Booking Holdings, Airbnb, Adobe. I've recently looked into the dating businesses like Match Group or Bumble. Those are also relatively good businesses. And I think I said before, I have around 40 names on my watch list right now. And let me just say that I think having a watch list is incredibly important. Of course, having a watch list of companies you are familiar with, that you are kind of sporadically tracking what's going on with their business and then also their share price. This is important because when these businesses go on sale, you will be ready to pull the trigger, which you would not if you would not have a watch list and had done some prior work on the business economics and the business fundamentals. Okay, question number 6. This is a fairly advanced one. So here 23% retired asked on Twitter. Acquisition companies like Constellation Software, how do they work and what's their competitive advantage, business model? All right. I would say that companies that are serial acquirers aren't really in my circle of competence yet. I think there are people that are much better candidates to talk about these types of businesses. I think there are a lot of Swedish serial acquirers as well that are quite popular on Twitter or in the FinTwit community. What I would say is, I would definitely be interested in these businesses long term, but I so far haven't found the time to really familiarize myself with the business characteristics of serial acquirers. And what I will say is that it's much more a bet on management than on the business itself, because if you are investing in serial acquirers, you are definitely trusting management to make very smart capital allocation decisions. As you might know, most acquisitions are actually not creating shareholder value, they are destroying shareholder value. And serial acquirers are often exceptions. They make sure that the acquisitions actually yield high returns for the business, for shareholders. Yeah, but you probably should talk to management. You have to understand the business culture, and Constellation Software is definitely a fabulous business. I remember taking a little closer look, I think in around 2020, when the stock was definitely trading below 1,000 Canadian or US dollars a share. Never pulled the trigger because it always seemed too expensive. But so has the business in the past, and the stock has done fantastically over the last, 15 years or so. Okay, this time a question from my friend Andrew. He asked, do you put more emphasis on the business strength or the strength and motivation of the management? And I guess this is actually a good follow-up question to the previous question. I think this is a tough one. What I will say is that luckily, I don't have to make that decision. And I would even argue that compromising on either the management team or business quality might often be a mistake. And in my investing checklist, I actually have a couple of overarching principles, similar to the principles Bill Ackman frequently talks about. And obviously, management and business quality are part of those overarching principles. And if one of these principles cannot be checked off, well, this is usually a red flag for me, and I just move on. Yeah, what it also reminds me of is an illustration by Todd Wenning. Again, I'm just going to find it for you and put it on screen. Basically, he has these three circles, kind of like a Venn diagram: mode, management, and price. And these three circles are overlapping. And he recently wrote a blog post, I think it was titled Mind the Gap. And he's basically referring to those parts where the circles overlap, but there's a gap because one of the circles does not overlap. So you might buy a business that has a great mode, that is available at a share price, but is run by a fraudulent management team. And despite a mode being in place and the company or the stock trading at an attractive price, you might still end up with a relatively poor result just because of the management team. At the same time, you might find a stock that is attractively priced, run by a great management team, but if a mode is not existent over the long term, there may eventually be a management transition, for example, while your long-term returns might not be satisfying. Yeah, but if I were forced to make a decision, say someone would put a gun to my head and would say choose management or business quality, I would probably go for business quality. I think it was Buffett who said that you can put the best jockey, i.e. manager in the world, on a goat, and he will, or she of course, will still have a hard time running the race. I think it was like, if you put a manager with a reputation for brilliance in place to run a business with a reputation for having poor economics, it will be the reputation of the business that is going to win in the end. Okay, question number 8, this time by Jeremy. He asks, what degree did political, country, or currency risk weigh into your analyses pre-2020, and what degree have these factors weighed into your analyses post-2020, and if they have changed, why? And I have to say, this might be the best question of all. Like, it's extremely nuanced, very up-to-date. I guess Jeremy is very, very aware of the fact that I did own Alibaba. I still own it, although the weight has decreased in 2023 because I reallocated some of that money to other stocks that I think, and I guess that's the point of Jeremy's question, to stocks that I think carry less or lower country risk. So I would say that my perception has changed here. So I would say not only China, but also the Russia-Ukraine war and what happened to Russian securities. And they have definitely reinforced that lesson that you have to be very aware of that risk. There's one checklist item in my checklist. I'm just going to read it to you. It says, I can say whether the business has high exposure to major adverse regulatory changes or subject to governmental intervention or retaliatory issues relating to different countries in different parts of the world. And I'm currently in the process of working on kind of a quality scoring system. And I might increase the weighting that I place on this particular checklist item just because it's so important. That it's super important to make sure that you don't end up with a 0 just because of country or geopolitical risks. All right, question number 9, this time from A. Flaskar. He or she asks, hi Renee, what do you think about investing in multi-factor ETFs like JPGL and following French pharma strategies proposed by Ben Felix and the Rational Reminder community? This one is a tough one. When I was putting together the presentation, I was briefly thinking about what to say, and I guess I'm not an expert on factor investing. I have previously talked about the quality factor, which I'm a big believer in. Obviously, price factor, in my personal investment philosophy, price plays a very significant role. I'm not sure how quantifiable that is because, say, a business is trading at a very high PE multiple because it's not particularly profitable yet, but the business has the potential to be super profitable. This is something that a factor-based ETF cannot really consider. So I'm not sure about the price factor. I do know that small cap value factor ETFs have performed extremely well, if I'm not mistaken. So that this may be something you want to look into. But I think generally speaking, I think Ben Felix, he does fantastic content, but his philosophy and my philosophy are probably at two different ends of the spectrum. I think he's more of an advocate for passive investing strategies, which I'm not against, but I do believe that if you know what you're doing, you can actually achieve spectacular results by investing in individual high quality securities. And I guess I'll leave it with that. Okay, I actually had one more idea that I wanted to address. So I was saying that small cap value ETFs, I think I would have to double check, but I think those ETFs have done extremely well over the long term, have actually outperformed the S&P if I'm not mistaken. Correct me if I'm wrong. But what I will also say is that in the small cap world, you will also find a lot of low quality businesses. I recently read that a very high percentage of the Russell 2000 components are actually not yet profitable. I think 40 to 50%. I guess I'll double check and show it on screen. So yeah, we'll get to small caps again in just a second. I know there's another question. So let's move on to the next question. All right, question number 11, and bear with me, there are 14 questions in total. This time from Phantom Dreamer, he asks, can you cover return on X, where X equals equity, capital, etc.? How do you calculate it? Which do you prefer, and how do you use it? Very complex topic. Obviously, I cannot discuss it in depth in a Q&A video, but what I will say is that whatever metric you are looking at, be it return on equity, return on invested capital, return on assets, in reality, all of these metrics are backward looking. So in an ideal world, you would always calculate the ROIC, which is the return on incremental invested capital. That's the return you earn on the investments you make right now. Obviously, we don't have a crystal ball. We don't know what the returns on future investments will be. But I think this is where having a good qualitative understanding of the business and the industry and the runway comes into play. And that is something I actually teach in my mentorship program. So I guess I'll leave it here. Okay, next question, number 12. And this time the question is, what would you consider your biggest milestone on your wealth building journey so far? I would say Charlie Munger has always said that the first $100,000 are the hardest, but you got to do it. And luckily I've achieved that milestone in the past already. And I have to say that ever since I've taken the foot off the gas a little bit in terms of my personal finances, I think especially early on in your wealth building journey, it's incredibly important to focus on your savings rate, which includes, well, first of all, your spending habits, but also maybe ways to increase your income. And once you have crossed that threshold, although to be fair, I think Munger said there's like 20, 30 years ago, and in today's terms, it's probably more like $200,000. But I think once you get the snowball rolling, you can focus more on the investing side of things, trying to truly optimize your returns. And I think that's kind of the process I'm going through right now. Okay, we've got 2 more questions. So another one from Omi Nolo. He is asking me whether small caps are worth taking a look into. And what I will say is, first of all, of course, as an investor, and especially as a retail investor, your biggest edge may be that you have no limitations. You can look wherever you want, every country, every market cap, every industry. And I guess the more rocks you turn over, to reference Peter Lynch, the more opportunities you will find. And there are plenty of opportunities in the small cap space. Many of these stocks are not as well covered as the mega caps. However, and this is something I also frequently reference, Robert Vinal has written in one of his annual letters that even the mega caps, so the businesses everyone knows, the Googles, the Metas, the Amazons, they get mispriced too quite frequently. Just look at Meta last year, or it's 2 years ago now, so late 2022. And the stock is up like 200% ever since. Everyone knew Meta, but the sentiment just turned so negative that if you were able to have a long-term outlook, have done the work on the business, you could get great returns even in that space. Okay, and then the last question by Andrew again. I think this was on Threads. He asked, you can only eat one more meal for the rest of your life. What would it be? So again, this is maybe more of a personal question. I'm not much of a food person, I have to say. So I was thinking about it for a little bit. I guess if you would eat the same meal every day, it would have to be healthy. It probably should include quite a broad mix of ingredients. And I was actually asking my girlfriend what she would say would be the best choice for me. She kind of probably knows my tastes better than I do. And she said Thai curry. And I guess I'll just go with that answer. Actually just had it today. And yeah, with that, I'll wrap it up here. Thanks for taking the time to watch, and let me know how you liked the video. Talk to you soon.